Let's look at those big banks, Mr. Conrad. It would
Yes.
seem, based on how they're performing today, the fact that you call them all market perform and they are all close to what I see to be your price target, that you don't think these big banks are the place to put fresh money and that they may be fully valued. Am I right or wrong?
No, I think that's fair. I think when you look at the banks overall, in terms of the banks that reported today, Bank of New York is a little bit different animal, but also a GSIB, that's up strong, up over 5%. We do like that name, but it is a different animal here. But in terms of these large banks, JP Morgan, I think, had a very solid quarter. They had very strong investment banking, up almost 50% year over year. But it is trading, near 13 times 2025 numbers. That is above its historical valuation. And most of financials are at a steep discount to the market. JP Morgan isn't as much. And so I think that valuation, it's off today a little bit because it's overowned and has a valuation, and they were relatively consistent with their guide. But it was still a really solid quarter. It's just a matter of valuation.
Yeah, there's not much to nitpick in J.P. Morgan or in Citi. I suppose people are pointing to the net interest income gap at Wells Fargo as the big problem there, which is why that stock is down as much as it is.
Yeah, with Wells Fargo, that's been a turnaround story. They've done a great job in really lowering expenses and buying back stock and restructuring the company. Today, we had a little bit of a setback and kind of a recast of our expectations. They did disappoint on NII. And, what's interesting is they didn't change their full year guide, but they moved to, closer to 9% relative to closer to down 7%. So a worse guide than what we were expecting. People are scratching their head because they're asset sensitive. Rates are now, although we expect the Fed to cut later in the year, for the bulk of this year, they've been higher than what we've expected. And so that should actually be a tailwind for Wells Fargo. But it hasn't. I think there's two factors. One, loan growth has been disappointing. And that's really true for the industry. And I think that's a read through for next week as well, that really the only loan growth is credit cards. I would circle back to the fact that debt capital markets is wide open. And so I think bond underwriting is stealing a little bit of share from corporations tapping banks' balance sheets. The other issue is deposit costs are still creeping up, even though the Fed is done raising rates and potentially lowering rates later this year. There is a lag in deposit costs. With Wells specifically, they had some adjustments and higher costs in wealth business. And so I think that's a little bit more of an outlier than what we'd see for the rest of the names next week. But those are the two factors that drove the lower NII.
I noticed that. I thought that was interesting, David, that customers, you read through to that, and they're getting more savvy, and they're looking for higher yielding places to put their deposits. Do you think Fed rate cuts stop that if they're only cutting 25, 50 basis points?
I don't think it will in the first couple moves. I think, to your point, banks are actually still, their entire deposit portfolio is still actually below market levels that you'd see in money markets. So I think it depends on the mix. But if you have heavy consumer, heavy wealth, I think you'll have a challenging time moving down your deposit costs over the first couple moves. In fact, it could go the opposite way. You could have up costs and down rates. Now, Bank of New York, again, reported today, their deposits are almost all institutional. So we expect a really strong deposit beta on the way down. So we think that name's unique, that they will get the deposit costs down.